The topic today is taxes, and in particular, we're going to be talking about depreciation recapture. What happens after these deals go full cycle and you have to pay capital gains and pay back that depreciation back again that you got in the earlier part of the deal. Of course, here's the legal disclaimer. And normally I guide you through this, but I was smart because today's presentation is a little more technical. So I decided to bring on Phuc, who's a CPA, to help. Let's just set the basics here. So on the left side, we've got ordinary income, which is thumbs down. We don't want too much of that, right? Although when you're first starting out and your net worth isn't under a million, a couple million, you need ordinary income from your day job or your business to get a base for investing. Ordinary income comes from your W-2, your 1099s, but it also gets hit up with all these taxes, right? What we want to get to is on the other side, which is passive income. It's cool because not only does it come in with you not even working, but it's also from a tax perspective, something different than ordinary income. And as it can be zeroed out by passive losses or depreciation coming from the real estate. So this is we'll begin with the end in mind. This is why, depreciation recapture and depreciation is a big thing, because a lot of us are using this to manipulate and their AGI, or just simply canceling out their passive income that they're getting from their rents or syndications as passive investors. Again, we'll go through this multiple ways, and I think Phuc will explain things a little bit differently, which I think is great because you guys can hear it different ways, and certain ways will resonate more with some people than others. But passive, you're getting passive income, but you're canceling that out with passive losses, or what we call PALs. So the next question is, where do PALs come from? Right, passive activity losses. So if you have a house here on the right side, the red part is where those passive activity losses come from, and those are the improvement portion of the real estate. The land, which is the green portion, is not depreciable. And so you can't really write that off. Land doesn't degrade over time. One general rule of thumb that I have is in secondary and tertiary markets, a lot of the markets that we'll invest in, Alabama, Phoenix, Texas. I guess Phoenix is a little bit more expensive. 30% of the market value of the property will be the land. So the majority of it will be depreciated, meaning that you're going to get more depreciation on the front end. And then a lot of the primary markets that we'll live in, such as Hawaii, California, Washington, a lot of those properties are flip-flop, where 60% of the market value is going to be the land, and the minority share, still a big portion, 30%, 40% or so, is going to be that red portion, which is the home improvement portion. A little bit of an example, I bought a property back in 2009 in Seattle. The price at the time was $360,000. I think today, I'm sure it's almost $1 million. That's why you buy real estate and wait, or the best time to buy real estate was yesterday. And the improvement portion was about $200,000, that red portion. And with single family homes, you can deduct that over 27 years. So 200 grand divided by 27 came out to be about $7,400 per year of depreciation. So that's how it is on a little single family. So things get a little cooler when you get to bigger deals, because you can do what's called a cost segregation. And what a cost segregation does is this big engineering study that breaks down all the components of the things that are in the red here that are able to be depreciated. It sounds really complicated, but all of this kind of happens behind the scenes with the CPA firm and the cost segregation consultant. Basically, from even our perspective as syndicators, costs us, usually we pay $5-8 grand to these guys to come in. And this is why it makes more sense on bigger deals to take that $5,000-8,000 price and make it worthwhile, right? Whereas it depends on how long you hold on to the asset, how expensive the property is, but at some point, especially on a smaller single family home that you may likely unload in the next few years, when you realize that syndications are a lot more scalable, paying $5,000 to $8,000 makes no sense at all. There are some of these guys out there that will do what I call fake cost segregation studies, where they don't really send anybody out there, and they'll usually cost maybe $500, $1,000, and then they'll require you to get audit insurance on it. Might cost extra $50, $100, but there are guys who will sell those, right? And as you guys have always told you guys, we live in the world of financial products. Not all of them make sense for you guys, but they're all tools. So be careful in that. I've talked to a lot of investors who got duped into doing these cheaper cost segregation studies, only to realize that they're going to unload those rental properties and they have to recapture the depreciation at exit, which is exactly what we're talking about here. But yeah, here's a little screenshot of K1. I think this one, $50,000 is what an investor invested, and they got $36,000 of losses. I would say that's pretty normal, plus or minus 10 to 20%. Of course, there's big varying ranges of prices of property. Amount of leverage is a big factor. How much CapEx is in the plan, right? And then how good a cost segregation study and how aggressively a CPA might take a cost segregation study and then apply it to the tax return on the business. I mean, here's a little bit of, maybe a little bit too much in the weeds. Like I said, not super important for passive investors to understand this completely, but basically what it's doing is it's breaking down that property into all these little components and arranging said components into different categories based on their depreciating timelines. For example, the 5-year property, the 7-year, the 15-year, and then the 27.5-year stuff that you can't aggressively write off as much. But as a rule of thumb, for passive investors, normally you're able, with a good cost segregation study, you're able to write off a third of the building improvement, that red portion, all in the first year, which is a lot faster than you're doing your straight line 27-year depreciation. But I don't know, if we get any more insight in here, sometimes people are interested in what's 5-year, what's 7-year. I don't know why they would want to know.
So what I would like to add to this is, when it comes to the cost segregations, what it is, you're just pretty much speeding up the process of depreciating, because normally if you just calculate in the building, the IRS says just take 27 years of the cost of the building and just divide it evenly. And that's what the amount that you get. But with the cost segregation, it's just, you're separating each item, like the toilet, the bathtub, the cabinets, and each of those items is not depreciated over 27.5 years anymore. It's more like 5 years, 7 years on average. So what you're doing, you're speeding up the amount that you could deduct upfront right away. So a good example I like to give to clients is that, let's just say if you loaned 10 family members money, do you want to collect all that loan money back within 27 years? Or do you want to be able to pick and choose, okay, this family member or these 3 family members will pay me back in 5 years, these 3 pay me back in 7 years. So of course you're going to want more of the payback upfront, right? That gives you a way to pick and choose how you're going to get that money back faster. Instead of waiting a full 27 years, by cost segregation, you're picking and choosing what could be depreciated a lot faster and taking the deduction upfront.
That's a good example. I want it as soon as possible, right? But this cut slide sums up what we just were talking about. Why does it make sense to accelerate depreciation? And so elegantly put, theoretically, you're losing ground on the gain to the tune of 10% by accelerating depreciating. You're making up most of that ground instantly because you're getting a deduction now against your current income, which could be taxed at 32% or more in the future. You get these tax savings immediately. The recapture would come at some point in the future where you would have to pay taxes on that. And we'll get into those individual tax rates on the depreciation recapture here in a bit, but that'll most likely be years from now. Maybe even you age out and you die with it. At that time, your income may even be taxed at a lower rate, which is awesome, right? So getting the tax savings now, then paying that back later, essentially no interest loan from the government. So you could use the money that you would have gone to paying those taxes to invest in something else. Investing that money wisely could potentially earn more than the difference between the 2 tax rate. Let's say you hold on to the property for 5 years. All you need to do is invest in something that produces a 1 to 2% return every year to break even. More crudely put, take the tax savings now, invest it and grow it, and then you'll find that you have a lot more money to pay the taxes on this when you kick the can down the road in the future. And I think that's why it's good to have somewhat of a relationship with your CPA, and then don't waste silly questions like what's 5-year and what's 7-year depreciation with your CPA. You want to ask these good juicy questions to your CPA, like, I guess using myself as an example, 1 year I didn't pay taxes and I was like, wait a minute, shouldn't I at least pay some taxes? After all, when you make under $100,000 or $200,000, your tax rate isn't that high. Like, why would you drive my AGI down to almost nothing? And my CPA was like, yeah, I noticed what you were doing with the syndication thing and investing. And guys, like, just take the tax savings as opposed to maybe saving 10 to 20% on taxes in the future. So, and I think that's what comes from an experienced real world CPA, right? Where they understand what you're trying to do. They may not know what deals you're going into or what's the projections or when is the recapture and, at how much losses you get the first year. They have the experience that, generally speaking, investors, people that are growing their money prudently, are most likely better off just paying no taxes now and then kicking the can down the road, and take your chances that you can kick the can down the road in the future. This is essentially the conversation, but I don't know, Phuc, do you any ideas and any additions to that? Or
No, I agree. It's better to take the tax deduction faster and now, because the value of the dollar is worth more today than it is tomorrow. So you want to get the tax deduction now, get the tax savings now, instead of just waiting over a longer period of time to get it.
What one example that might counter this point is, like, say you're one of these like investors that like to go into just a small amount of deals, but really big, like you put 500 grand into a development. I like to diversify into a lot, so I don't deal with these high spikes in income 1 year or another. But hey, you guys can all invest in how you guys want, and that's why you guys interact with each other and you learn different techniques and ideas. But say you're one of these types of investors and you knew a deal was exiting next year, and maybe you want to hold back on some passive activity losses next year. And you need to keep this idea of AGI income smoothing out, which is keeping the highs not as high and the lows not as low, and keeping within this reasonable band for the most part. So it takes a feeling for that. Here are the tax brackets. And like how I said previously, there's a certain threshold. I always say around 350, 360, kind of where this red line is, right? Where the break between the 24 to 32% tax bracket, there's a bigger jump there. And then the more and more you invest, the more passive activity losses you kind of bank on your 8582 form, where you become a little bit more immune to that as time goes along. But that's the general idea. Here are some real K1s that a lot of this is real simple. You get the K1, which has the losses, and here are some of them. Like, some of them are really strong. Like this one was like almost 100% of what you put in, 180K investor put in, and they got 176,000 first year losses. I've even seen it over 110%. That was crazy. I have no idea how that happened. It's always better to be a little bit more conservative and just assuming for 100 grand, maybe you're getting $50,000 to $60,000 of losses that first year. Like 42,000 investment, they got back 25,000 here. And you're seeing this on the bottom of the form here. So what is depreciation recapture? So the asset depreciates over time. So it's depreciable. Basis is the cost of that acquisition of the asset, which is the purchase price, plus the cost incurred to put the asset in service. The value for the yearly depreciation is categorized as a loss for tax purposes, since the property are depreciating and becoming worth less during the wear and tear on the asset. But when the property needs to be sold, and essentially in commercial real estate, you always sell at some point, it must be recaptured back. This is, some people will say, why take it if you're going to have to pay it back? Exactly on that last slide where we said you're strategically using the time value of money on your side. So this is recorded as a gain now in taxes and is subject to specific tax treatment along with the capital gain if you made it on that investment.
Oh, Lane, can I add something on
Yeah.
that when it comes to depreciation? What you mentioned earlier, where some people are like, oh, if I don't want to recapture, I won't take depreciation. IRS actually has a rule that states that even if you don't take depreciation, you still have to recapture the amount that you're supposed to take. So just make sure that you always take depreciation, because one, what Lane said is that you should take it because the value of it is worth it. But two, if you don't take it, you're going to end up paying extra tax on it anyways, even though you never took it. So just be aware of that. It's called the law of allow or allowable that the IRS has. So just make sure that depreciation you should always take.
And that's my biggest fear with this stuff is, these forms, you get these forms. It's not that difficult, but when you get like 50 or 100 of these K1s, it gets a little crazy. And if you say you misplace this one or you don't put it on, the way I do it is I have a little informal spreadsheet that I hand to the CPA so that it makes sure that I can spot check them on the amount. If you misplace or somebody fat fingers not putting 51 grand at a 25% tax rate, that's 10, 15 G's right there that I lost out on. So it's important to be somewhat organized with the stuff. So here's a case study, a deal we did back in Texas. This was a Class C property. I'm so thankful we sold this one because it was just a difficult clientele. But anyway, we made 100% return on investment in it in, was it 3 years? So here's an example of a K1 where an investor put in 200 grand. And you're seeing it on the K1 in box L right here, $153,824,000 of first year losses. And like I said, about 1/3 of the losses is going to be squeezed out of that lemon or towel or whatever you want to think about in that first year. And then it trickles out after that. And then in 2019, we were operating the property and we had an additional 27,000, or this individual had an additional 27,000 of losses. And they also had, I think, yeah, we refinanced. No, we didn't refinance, but we sold it and they had a gain there too. And then the last year K1, they had 11,000. So you got to add up all this, the depreciation, right? So what we did was we broke it down for not this larger investor, just corresponds to this particular K1, but say an investor just did $60,000 minimum investment. I think what it was, they got $138,000 back plus their original $60,000 principal. So they made a $78,000 capital gain, and that's going to be taxed at long-term capital gain and recapture. And I'll have you go over this later again, the difference between long-term and capital gain and recapture tax, just so we can go over it twice because it is a little bit more advanced. But yeah, assuming at a 15% tax bracket, which is low, a lot of you guys are much higher tax rates than that. That was estimated 11,000 in taxes. But if you took the full bonus depreciation, you could be at 15 because you got to recapture all this amount that we took in 2018, 19, and 20 there. But why don't you take over this one? I don't want to misspeak on this.
Okay.
Yeah.
And I'll have an example on the next slide, but pretty much there's pretty much in a way 3 different kind of brackets to look at, or 3 different type of taxes to look at. One that Lane just talked about was the long-term capital gains, which is 15%. There's a recapture that's treated differently. It's still considered like long-term, but it's maxed at 25% instead of 15%. And then the third one, just ordinary income tax, which is whatever your bracket is. So let's just say in year 1, you invested $200,000. And from year 2 to year 5, you took losses because of the accelerated depreciation, which is, let's just say $150,000. Now on the tax return over the years, you're storing up all these losses, because if you're in a passive activity, meaning that you can't take these losses against your other income right now, it's just storing it up and saving it for later. And there's only 2 ways you could really take everything that was stored up. There's only 2 ways to really be able to utilize it. Is one, the first one is the most common one, is when you sell the property. So anything that's been accumulated over the years, you get to use it. All those losses, you get to just it gets released and you get to use it right away. And the second way, which is a really slow way that not many people use, is if your property starts having profit on paper, then those losses could help go against those profit later on. Or if you have maybe like a second, third rental where it's actually showing big profits, then those losses could help offset those gains. In this example, we're just going to use the most common one where once you sell the property, say in this example, in year 6, let's say sell for $300,000. The first tax rate you're going to look at is long-term capital gains, which is pretty much just the delta between $200,000 and $300,000 sales. So 15% rate, that's $15,000 taxes. Now, here's where it gets a little bit complicated with the recapture and everything, because with all those passive losses that you weren't able to take, but now that you sold it, all of those passive losses are going to be released in year 6 because you sold the property. And that goes against your ordinary income as well. So if you have W-2 income, 1099 income, or anything like that, those passive losses will go against the high tax bracket items as well. So in a way, by taking these losses, you're saving 32% on your taxes just by doing it that way. Now, same thing with the recapture. When you sell the property, you have to recapture depreciation. So everything, assuming that all the losses are coming from depreciation, that's why you have such a big loss. When you recapture the depreciation, all of that becomes income again, but it's only taxed at 25%. So in a way, you're deducting from 32%, but paying taxes at 25%. That leaves about a 7% kind of, you're up ahead 7 with the taxes, meaning that their overall savings is around 10,500 if you're doing it this way, where you're using your passive losses to deduct it from the higher bracket, then paying taxes on it at the lower bracket. So pretty much deducting at the higher tax rate, paying taxes on the lower tax rate.
And that's where we always, I mean, we're marketers in a way, right? Like syndicators, we have to be careful in saying, it's not like you're getting away from the taxes, but it is efficient, right? Because there is that 7% delta. But I'll open up for questions here on the slide, but I guess Phuc, like that 32%, 25% delta, tax rules change from time to time, right? Has that thing ever changed, or you see it going away?
The 5% I haven't seen change, but the tax brackets could change, like the Trump tax reform that passed in 2017. That lowered everyone's bracket a little bit, but it's supposed to expire in 3 or 4 more years. Now, right now, you might be in a 32% bracket, but after the thing expires in 4 or 5 years, you might be in a 35% bracket.
Yeah, so that delta will even be greater.
Correct.
And yeah. Any questions before we get moving off of the slide? Yes.
Question in the chat about, he said, property is depreciated in 5 years. How is it possible to get more than 20%? So you could have more than the 5-year, say, broken out amount if you use 179 deductions and bonus depreciation. So it's still possible, but there are special rules to know about that before you do that.
I think since we're on our recording, I'll explain, I think, the confusion that led to that question. Depreciation is off the size of the asset, but your investment isn't, the LP's cash that they invest doesn't equal the total size of the investment. It's only a portion of that.
That's
right?
Correct. And I think like LPs, like when I talk to you guys, it's always about off of your basis of your investment amount, right? Because that's simple and easy. But you're exactly correct. The difference between how much you invested is really not really correlated to how much losses you get.
Yeah. So if a building, if the initial investment is only 20% of the size of the asset, and you could depreciate the asset only 10% in the first year, the LPs would see something like 50% depreciation on their ones.
Let's get away from this percentage thing. It's just how much depreciation there is, and that gets divvied out pro rata to equity investors.
And that was where my confusion came from, is we wind up talking about this as percentages.
You're exactly right, because this is a marketer trick here, right? Because you have a lot of people touting 100% bonus depreciation, but they're talking about bonus depreciation, right? It has nothing to do with how much losses you're going to. They don't know how much you're going to get, right? So they shouldn't say, but they use this 100% thing and making it allude to and dupe newer investors that, oh, if I invest 100 grand, I'll get 100% in losses my first year. Not the case. I'll put in another example here too, and this is the extreme, but say you had an apartment building and just you were the only common equity investor. I don't know why that would happen. Just say out of the equity, the capital stack for the equity side, it was a $10 million raise and $9 million came from a preferred equity investor, and they don't care about losses. They just wanted returns and they got paid on a 1099. So they left all the losses to you on that. Let's just say that's a $30 million asset. 1/3, like I said, 1/3 is the general rule of thumb for the losses that come out in the first year. So you have $10 million of losses. And you, sir, are the lucky guy who put in $1 million and you take all $10 million of those losses, right? It is not correlated, just an example, extreme example, right? But that's how it flows down. Does that go over the scope of most LP investors need to know? Yes, of course, but you guys like to understand this stuff a little bit more, but that's how it works. That's why there's some detachment in there.
Yeah. What I would like to also bring up is that making sure your account is helping you track your basis, because that's part of how you calculate the losses as well. Definitely, you need to have an account that understands what your basis is and what you invested into it, what loans you took out into it, and keeping track of all that, because you could be subject to limitation how much losses you can take depending on what your actual basis is.
Question here. When does the first year of depreciation start? When money invested or when the construction completed and the property is in service? I'll take this one. So your first year of depreciation starts when you make $1 in that business. So in, say, a development, say you invest this year, but the thing isn't built until next year, but doesn't start taking in renters till 2 years from now. 2 years from now is when those depreciation can start. Similar to some of you guys have not invested yet, and maybe you're doing some education, some business startup expenses. Again, yeah, they're called startup expenses. You can't really deduct it unless your investments make money. The same idea there.
Hey, Lane, sorry, I just got to add to this. It's for, say if it's a single family resident, it's when it's ready to be rented out pretty much. So let's just say you fix it up in October and then in November, you're ready to rent it out. It's just you haven't found any tenants till maybe January of the next year. But as long as you're trying to find tenants and it's ready for someone to come in, then that's when you could start depreciating it and reporting all of the expenses too.
Yeah, good catch. That's it goes to this year intention. Yeah.
Correct. Yeah. As long as it's ready to be rented out. So same thing with business. As long as you're ready, if you're open for business, you might not be able to take on any clients yet, but once you're open for business, then you can start deducting.
Like I said, there's different interpretations of this stuff, right? I personally try to be more conservative, and then that's where I like when Phuc goes on the limb there and corrects me, and he's willing to be more aggressive, right? But there's a big spread in CPAs, and most of you guys will change your CPAs because they're a lot more conservative than myself, and they just don't have a strong understanding of this stuff. Another example that is like, we talked about long-term gains. Some CPAs will call it 3 years or more. My CPAs who do the syndication side will typically be in the range of 1 to 2 years. Phuc, where are you guys in that, into making that determination?
It's just 1 year, anything over 1 year. Yeah, 3 years is, that's definitely wrong.
Yeah. Some people will also say like your intent too, right? Or is that more 1031 exchange?
Yeah, the intent definition does get skewed depending on the accountant and depending on the type of person you are. So if you are more conservative, then you should want a more conservative accountant, which is fine. If you do want to be somewhat more aggressive, then you got to find a more aggressive client. And the way you determine an aggressive client is not taking deductions, whatever you want, they'll give it to you. That's not really aggressive to me. And this is how I define myself as well, is that I'm not afraid of an audit. I'm just afraid of losing an audit. So as long as I know I could have more than a 50% chance of winning the audit, I'll take the deduction for the client. But there are a lot of other accounts out there that they're just scared of audit in general. Like they're just scared of the IRS and dealing with an audit. Having an audit is not a bad thing. All it is just someone checking the numbers. And as long as you could prove the numbers are right, then the audit will go smoothly. It'll be fine. But a lot of accountants who are conservative, they're just scared of having an audit in general. And if that's the type of person you are, you just don't want to deal with IRS and don't have any trouble with IRS, then the conservative route is perfect. But if you want someone that is actually going to be looking out to making sure that you get everything possible, then you might want to choose someone that's not scared of an audit and is quote unquote aggressive in that they're going to review everything that you can try to take as deduction. And if there's something that's little, maybe not, go into more details and try to figure out, okay, what are the chances of winning the audit if we were to do this?
Most people are not investors and they just do W-2 all day long. They have CPAs for that. But a lot of you guys are falling on this other side of you're doing things somewhat alternatively, and you need to take advantage of these. That's part of the reason why you get on the alternative investments, to make more money, but then open up the ability to implement these legal tax strategies that we're talking about here. And then I think if you can get a sense, like Phuc's a guy you can have a conversation with, right? Like a lot of times, sometimes, and this is why we urge you guys get educated on this stuff first. We have a lot of material to at least read through. And then once you're somewhat educated and empowered, then have the conversation with your CPA. Because sometimes when you guys go to the CPAs, most times the CPAs are just the wrong CPAs from the get-go. But sometimes when you go to the CPAs and you come with them with a half-baked idea, or they get this feeling that you're going to be a real pain in the butt client, then they can make it difficult for you guys. Nobody wants a client that they have to teach.
And Lane, can I go through some of these questions that's already on the board?
Yeah, I'll read it here. I thought passive losses could only be applied to passive income. Why are we able to put it towards ordinary income in this scenario?
So in this scenario, it's because we sold the property. Once you sell the property, all those passive losses gets released and it could go against ordinary income. So hopefully that answers your questions. Next one.
Wait, so let me ask a follow-up to that, right?
Okay.
Because now you just got a lot of people excited. So if I make $600,000 merit fall jointly, and these losses a big deal exited, and I had $300,000 of passive losses or release back, how can I use that to lower my high W-2 ordinary income?
Yeah, it will get released. Most likely it'll because your income is going to increase even more because of your capital gains as well from selling the property. But if you do have a lot of losses and have a lot of clients that just have accumulated losses over the past 20 years, and they have $400,000 or $500,000 worth of rental losses that they couldn't take during those years, but once they sell the property, then all of those losses they get to utilize right away.
One comment here: audits cost the client money, not the CPA.
For this one, it will cost money for the audit, but let's just say we charge by the hour. It's $250 an hour. So let's just say an audit's say 3 or 4 hours, right? So that's say $700 or so. But definitely, I've never lost an audit, so I'm definitely sure that $7 is worth to pay for the audit. So we could take say an extra $5,000 in deductions, which is probably an extra $2,500 in savings. So you still come out ahead as long as the audit you're going to win the audit. For me, because I never lost an audit, and I'm always very careful when it comes to what can I win in an audit versus lose. So if it's one of those examples where a client says, oh, I heard from my brother's neighbor's friend that I could do this, and then it doesn't sound legitimate, I'm just going to tell them, no, I'm not going to do that for you. But if it's something that's going to work, then I'll do it. And as long as I know that I could win the audit, then I'll take it. So I'm not scared of the audit.
So a clarifying question here. So you can use the passive losses from other properties against the current property that you just sold, which is now active.
So that one could get complicated. So there are ways to release all of your passive losses. You have to do a special election with all of your rental properties as one rental property. So this is where you probably want to talk to, if you have multiple rentals.
What about syndication deals, right? You're totally
that one
passive.
Probably won't work. No. Yeah. So I usually see it with some of my clients. I usually see it when they actually own the rental property themselves. They'll have 6 or 7 of them.
All right. So more examples.
Okay. So let me see. Okay. So this is an example of, since Lane was talking about accelerated depreciation. This is the example of taking accelerated depreciation versus not taking it. The left side is what we just talked about. That's the example I just gave earlier. The right side is what happens if you don't want to take accelerated depreciation. Let's say you just want to do regular depreciation because you're maybe more conservative, right?
Sometimes, real example, sometimes we will elect not to do a cost segregation because we will, what our CPAs tell us is that if a general rule of thumb is if we're holding on to an asset longer than a few years, then yeah, it makes more sense to do a cost segregation, pay the 5 to 8 grand to extract that. But if it's less, then it's a waste of money because you got to recapture it back. But that would be a reason why we wouldn't do a cost segregation or aggressively depreciate it.
Yeah, so with this example, with regular depreciation, same thing, you invested $200,000. But because you're taking regular depreciation the first 5 years, you're probably only taking around $30,000 worth of depreciation instead of the $150,000 in the example before. So on the return, you only have $30,000 worth of passive losses being stored up. So then if you were to sell the property, the capital gains would still be the same. Let's just say you sold it at 300,000, capital gains is 100,000. So total tax on that is 15,000. But here's the difference when it comes to taking accelerated depreciation versus regular depreciation is that because you only have $30,000 of losses released, you're only deducting $30,000 from your ordinary income, right? And then you're also recapturing $30,000, which isn't very high. But if you net it out, the 7% on $30,000 is only like $2,100 that your overall tax savings is by doing it the regular depreciation way. So the percentages stays the same. It's just because we're dealing with bigger numbers now. So the results is going to have bigger tax savings in numbers wise.
So the same chart that we started with, we added a couple other concepts on there. So ordinary income on the left, passive income on the right. This chart here with the long-term capital gains rate for 2022, the basic premise here is if you guys are able to lower your AGI, you're also able to lower the long-term capital gains taxes when you have these exits on deals. Right now, you might be sitting at a 20%, but if you're able to nudge your AGI down through a myriad of different strategies, don't know if we really want to focus on that right now, but maybe we can get into the Q&A at the end. But you can maybe drive yourself down to that 15% range, or even get yourself to that 0% range if you're able to drive yourself under that $55,000, $60,000 range. And then like passive activity or passive losses can be used to offset your passive income, such as your rents and your syndications. But there's a red line here, right? There's a wall. You can't use your passive losses to offset your ordinary income, your W-2, unless you have real estate professional status. And there, the way I explain it is like a bow and arrow, right? The real estate professional status is like the bow, but you need the arrows, which is the passive activity losses, to go out there and do some damage to your AGI and lower it and pay less taxes. To get this bow or real estate professional status unlocked, or get the badge, or check the box on your taxes, however you want to call it, a couple things have to be in play. And I'll let Phuc correct me too if he wants to take it a little bit more aggressively. But for the most part, you can't have you or your spouse can qualify, but one of you guys can't be working a full-time job. And then there needs to be 750 hours of active participation in your portfolio. So meaning you may have to own a rental property or a few, or a short-term rental.
Yeah.
But any revision, I try to keep it real simple. There's a bunch of these like rules and things you have to qualify, but
yeah, the real estate professional, it is a tough thing to qualify because there's all these little mini things that you got to fall into before you could qualify. Generally, married filing, joint filings will have a little bit easier as long as one spouse doesn't work, as Lane mentioned. If you're filing single and you have a full-time job, you normally won't qualify. So unfortunately, that won't benefit you. But if you're in a situation where maybe you don't have a full-time job, maybe semi-retired, and you have all these rental properties, then you could qualify for the real estate professional. If you meet those tests like that Lane mentions here, the 750-hour test, that means that you have to spend more than 750 hours a year participating in your rental, whether it's fixing it up, making sure that it's running correctly. And if you only have 1 or 2 rentals, you probably won't get this, because I think it comes out to be like 14 hours a week. So you would need multiple rental properties, and you must be busy with the rental properties to be able to qualify. And that's just a 750-hour rule. The next rule is a 50% rule, meaning that all of your working time, 50% has to be done on the rental property. So even if you have a part-time job, you have to make sure that more than 50% of your working time, including a part-time job and your rental activity, is 50% is being spent more on the rental properties itself. Then you also got to materially participate, which usually means you got to actively work on the rental. So little office stuff won't count, like depositing checks and stuff. That usually doesn't count as towards the hour. Make sure that you do qualify for those 3 main tests to qualify as a real estate professional. And the reason why you want to do this is because if right now, if your income's over 150,000, any losses you have on rental properties, you cannot take. But if you're a real estate professional, if you have losses, then you could take those losses against your ordinary income.
Yeah, so a couple of things on the rep status that always comes up. First, can I be a real estate agent? And being a real estate agent, broker, has nothing to do with 750 hours of active participation in your portfolio. That keyword is your portfolio. And then the other thing is, but I like read a lot of videos and I do education and a lot of podcasts. That falls in more education kind of phase and would not qualify.
Correct. Yeah.
But I think what at least my goal is to get you guys to a certain level where you are able to have this conversation and see if you qualify, because there's a bunch of people I think here that have full-time, both spouses have full-time jobs. Somehow the CPA is checking the box for you guys. I don't know, but yeah, have a conversation with your CPA on that one.
Yeah, you definitely, if you know you qualify, a lot of CPAs that I know, especially some of the older ones, they don't this rule, they don't like taking it because it is a chance of a higher audit. Because if you're taking big losses against your regular W-2 income, there's a good chance of it being audited. I've gone through a couple audits with this. I've won those audits, so I didn't have to worry about it because I knew that the spouse wasn't working, so it was an easy qualifier. And then just making sure you track those hours. When I talk to my clients and we do this, we make sure that you are tracking your hours. So how much time did you spend at this rental property doing repairs or whatever? So making sure you track those hours, because they will ask for it in an audit. So if you can't provide how 750 hours came about, they're not going to let you take it. And then all those losses you took for 1 year, they're going to go back multiple years because they're assuming that you took those big losses as well. And then you're going to have to pay taxes on all of those losses that you took. So it could get pretty messy. So make sure you do have everything in order and make sure that your CPA knows that what they're doing when it comes to this as well.
Yeah, but those fees aren't that bad, right? Because it's at least this year, because inflation is so high. But that's a side thing. But I guess like a question that comes up commonly is like, how do I log those hours? What do you tell your guys on that? Like Excel spreadsheet?
Yeah, Excel spreadsheet would probably be the easiest. If you want to go old school, you can have a notebook if you wanted to do that, but that's going to get messy and you don't know if you're going to lose out on that notebook or not. So I always tell do Google Sheet. That's a lot easier. Take pictures, save it as a PDF or as a image as well.
Yeah, so the bad thing about the Google Sheets is like technically you have to log revisions on there. So if you're one of those guys who makes the log after the fact, then it doesn't look as nice. But you guys don't, like as a CPA, you guys don't collect the log, do you? You just ask the client, right? Hey, you got your
I'll tell them to have a log, but I'll tell them give me the total. So I don't really need to look line by line. I'm not gonna spend that much time on doing that. So they have to give me the total somehow.
Yeah.
Yeah. Because remember, as a taxpayer, you're still responsible for tracking everything. The accountant's just responsible for reporting it, but you're still responsible for keeping all the records for it.
And then I've said this before, but real estate professional status sounds really cool. But if your AGI is under those higher tax brackets, like under 350, 400,000, I don't know if it's quite worth the brain damage to go about and do this. And what's unfortunate is like the people I'm thinking about are like the single guys or gals that make more than 200,000. You guys are getting killed with taxes, but without that spouse, it's hard to implement rep status. So go get married, but hopefully do it for love and you get a prenup. But the other situation is you have the dual income working couple that both make pretty good money. If sure, one person stays at home with the kids, and that might be the way to do it, right? Especially if you're above $2-3 million net worth, and that's what we talk about in the Wealth Elevator book that's coming out. Is at some point there is some threshold where you start to go for quality of life, as opposed to just burning the engines hot and making a lot of money and paying a lot of taxes in the meantime. But you got to remember, at some point, if one of the people in the relationship goes part-time or quits, your AGI goes down. So that might lower you under that threshold where it may make sense to do this. Where rep status really makes a lot of sense is like disproportionate incomes. Like you have a doctor making 400,000 or 500,000 plus, and you have a stay-at-home spouse. That's where this lines up pretty well. But I would also say, before we move on, the rep status is a bull. Some investors like to invest looking for deals that give them a lot of passive losses. If you're drawing low on your arrows or your suspended passive losses, we're going to be working so you guys can specifically do that. Hopefully you don't just wait till Q4 to go into that, but I guess that's what I think most people are going to do, right? Figure out what their taxable situation is and then figure out how much passive losses they need and go out and get that, just like how a lot of you guys have been playing around with the land conservation easements 22, and whereas now it just seems to be a little bit more riskier as the years go on. You want to take this slide?
Yeah, so this is just going back to the real estate professional, say a regular person who's not being a real estate professional versus a real estate professional. So trying to using the same numbers as the previous example. If you invested $200,000 and then you took accelerated depreciation of $150,000 on the tax return, every year showing up as passive losses is just going to be stored up. So you can't take any of those losses at all. So you can only take those losses once you sell the property or if the rental starts showing a profit on paper. But as a real estate professional, all those depreciations and expenses and losses that you incurred, you can actually just take it against your W-2 income. So on average, out of $150,000 from year 2 to 5, you're taking a $30,000 expense or loss every year. So by taking the losses now, you're just saving $9,600 a year. But just be aware that you do have to recapture this later on, and you don't really have anything to offset it anymore. But it's still better because you are getting a tax savings upfront because the dollar is worth more today than it is tomorrow. So if you could try to get any tax savings upfront early on, that's usually the best strategy.
And while we have this up, I try to tippy-toe around this, what we're going to talk about next, because I don't feel comfortable talking about this, but it's the dynamic of when you have real estate professional status checkbox or badge or whatever you want to call it, and you get passive losses from these deals. Is it true that it's like an ordinary loss at that point? Everything that you accumulate under your real estate professional
It's an
title
ordinary
badge.
loss. Yeah.
So what happens next year when you say your spouse decides to go back to work, or
you would uncheck the box. So then that year you can't be a real estate professional.
So if I invested 200 grand here and I got $150,000 that year as a real estate professional, I have $150,000 of ordinary losses that I can use to lower my ordinary income in the future years, even if I don't have rep status.
No, not in the future years.
Okay.
Yeah.
Okay.
You could only take those losses in the year you are rep status.
Got it. Okay, cool. Glad I have you here. I think something like that I'm still wrapping my head around it. And as passive investors, I think that is really where you trust your CPA at that point to be doing things the right way for things like that. I think it's good to be aware of this stuff, but it gets a little complicated, right? Here are the tax brackets, and like how I said, previously, there's a certain threshold. I always say around 350, 360, kind of where this red line is, right? Where the break between the 24 to 32% tax bracket, there's a bigger jump there where it might make sense for you to implement real estate professional status and go through that rigmarole of 750 hours and one spouse not having a full-time job to be able to lower your income, say from $1 million down to 500,000 using passive losses that you may or may not have gotten from a deal or the handy dandy tax fund or myriad of other ways that people within our community will do that. So we've been going for about an hour, so everybody needs a little break here. So I put this in. So this is the analogy. The arrows is like the passive activity losses, the PALs stored in 85, 82 form. I guess that's your holster for your little arrow set. And then the rep status is like the bow. So everybody gives, what's his name? I forgot his name. What's his name? Somebody tell me. I don't know.
Captain America?
Oh, no, the arrow guy. I know Hawkeye. Hawkeye is in this world is pretty powerful for us. So hopefully that'll make you remember what we talked about today somewhat. But maybe Phuc, go over, we talked about like real estate, right? A lot of us invest in real estate, but what about, can passive activity losses offset dividend income from like portfolio or stocks, bonds,
No,
mutual funds?
unfortunately not. So the way I like to describe when it comes to income and reporting income, imagine it in buckets. So there's like a wage bucket, there's a dividends and interest bucket, and then there's a stock sale bucket, then there's rental bucket. So usually all the buckets stay within their own categories. So only rental losses could go against other rental gains, but it won't be able to offset anything in the dividend bucket usually.
Dividend income falls under portfolio income, which is essentially ordinary income.
Correct. Dividends could be taxed at long-term capital gains rate too.
Okay, so there is that kind of similar component on both sides of this divide, right? Where passive income, you have long-term, short-term capital gain differentiated by 1 year is your rule of thumb, where there's different brackets. And then with your stocks, bonds, mutual funds, it is the same dynamic going, right? You get a little bit of break on the long term. What's that threshold on the long term?
So for dividends to be qualified as long-term, it has to be a US company. So Apple that offers dividends, like any US company. So a lot of stocks that you invest in would have qualified dividends. That's what they call it.
Not super common, but what is partial asset disposition? It's the removal of the remaining cost of a particular portion of the property that is taken out of service. The remaining cost produces a tax loss because that portion of the cost has not been deducted yet through depreciation. The interesting implication here is that it's replacing some items that could at the property while you own it could mean that you don't need to recapture the depreciation on it, and that could mean future tax savings. I don't know where this really applies to passive investors and syndications, but I could see where it could apply for syndicators or if you guys own your own little rental properties. I think that, how about we open up for questions here? I'll go first. So one question I get asked a lot of times is phantom income, if you could define that. Because sometimes investors will be like, hey, I've been counting my distributions like a hawk and I got 1,000 through the life of the investment, but it doesn't quite match what's on my K1. On syndication deals, say an investment makes $100,000 and you have 100 investors. Well, you would think that assuming normal pro rata splits, that each investor would take $1,000 of that income. However, sometimes it's based off of the equity structure or the way the split scheme is. So that's why things don't always add up how you would think. At the end of the day, it's not what you got as the investor in your bank account, but it's more what did the investment produce divided by pro rata to all the investors. But this is explained in the PPMs buried in there, but it's a very common question.
Okay, so I guess you're talking about the difference between the distribution and what's actually income?
Yeah. If you want to expand on that more, by all means.
So I guess the easiest way to explain distribution doesn't mean the money that you receive doesn't always mean it's taxable, because a distribution could come from also a payback of your original capital investment, while income is pretty much should be whatever was actually made on the deal itself.
Yeah. So when you get a K1, it's not particularly what you got, it's your percent pro rata share of the entire whole. If you guys want to type in your questions into the chat, I'll go ahead and read it. I'll get Mike's one here. I invested in a couple of deals using retirement funds and received K1 showing losses. Is that correct? I thought since 10 401k funds are already tax advantaged, the depreciation loss would go to the other LPs. I'll take this one. Again, this is why I'm not a huge fan of using qualified retirement plans. You get the losses because you're an equity investor. You get the losses, but you can't use the damn things, right? So you get them, but you can't use them because it doesn't flow through you personally. It stays in your qualified retirement plan, which is not technically you.
Yeah, so as long as your K1 is showing under your, I guess, your 401k or IRA account, then, but because it's in a 401k, nothing happens, whether you have losses or not. Unfortunately, you just can't take anything because it's inside a 401k.
Another thing that I see a lot, like in this K1 example here on the right side, these check boxes, they always seem to be wrong.
Yeah,
and
that
then,
one I don't really pay too much attention to.
okay.
As long as I know if they're are they actively participating or not, or is it more pure investment where they're more hands off. That's the main thing I would only care about.
Yeah, but that doesn't materially impact anything unless you're making a run for rep status, which you wouldn't be using this anyway for.
Correct. Yeah.
Yeah. I mean, I only pay attention to 1 and 2 and like number, was it 19? Or maybe this is an older form. I think it's number 19, which is distributions here. Yeah, here it is. That's the only thing I pay attention to personally. But how does it work? Like sometimes the spellings on these things are wrong or like an address is wrong. Does that even matter?
I don't think it matters. I think the main thing is having the EIN number. That's really it.
Because how does it work? So like so we'll file the syndication and then 100, 200 K1s. Does that go to the IRS or what do we do with that? Or what is
the
RCP?
IRS gets a copy of the K1 too.
Okay.
Yeah, because the corporate or the partnership return has to be filed and the K1 would be attached to that partnership return.
Yeah, we always get like a lot of questions on these like check boxes. And I'm like, I'm not the CPA, but it doesn't really matter.
I don't think it matters.
Another question here. Can you clarify what you mentioned about releasing PALs for syndications? It sounded like you said that we can't group syndication losses and that the losses only can offset that same asset's income. It was my understanding that we can use a new deal's losses to offset a recent sale of another deal within the same calendar year.
So if I understand correctly, following my bucket example that I gave earlier, as long as it stays inside the same bucket, then any losses could offset any of those gains from another investment that's within that same bucket.
Last question, and it's mine. So the tax PAL fund will be giving investors passive activity losses through investing in equipment via 179 deductions. Can you explain 179 and how that works, how that benefits passive investors?
So 179 is something that the IRS allows you to take a full deduction on the item. Instead of depreciating it, 179 will allow you to take it in full. So the ATM machines, let's just say the IRS will allow you to depreciate it over 5 years. And then instead of depreciating over 5 years, you get to deduct the ATM machine all at once in 1 year, which is part of the whole thing of trying to get the tax deduction up front now instead of waiting the full 5 years to get the deduction.
Also wanted to mention that section 179, you can't take more than what you make in the company. So it will not produce losses. If you do with section 179, it is 100%, but then you have to carry the 179 forward. But there is something called bonus depreciation, and it used to be 100%, but starting this year, unfortunately, it's 80%. But those can create losses in the business. So just wanted to clarify that too, in case you were going to go that route and take an accelerated depreciation looking for the business to have losses.
And I think that's another like common marketing trick people will say, right? Like last year was 100% bonus depreciation, this year's 80, and then next year it'll sunset 60-40 as like a scarcity tactic to get to people to invest. But the bonus depreciation portion is just a minority portion of the normal regular depreciation. And the normal stuff that you would get through doing a cost segregation too. I wouldn't, again, I think we talked about it earlier in the presentation of detaching yourself from these 80%. It's not, at the end of the day, you still get a very healthy amount of depreciation.
Yeah, it's just more like what type, again, there's two special types, like there's a 179 and bonus. And so you just have to decide in that year which one is good for you, depending on like your general goal. But both of them will help because they're both accelerated, obviously.
So yeah, if an investor picks up some passive activity losses from this equipment, is how it stays stored on your 8082 form to use in future years. They'll be investing as a passive. So through a syndication model, and then taking their share.
Got it. Yeah, for the passive, you could take 139.
And I think that's another common question that comes up, whether it's ATM equipment deductions as passive losses or any deals for that matter. Some investors, they get a little worried that, are they going to take my suspended passive losses away? Never say never, right? But that kind of mechanism has been in place since the beginning of time, where you can carry it forward indefinitely.
Yeah, you should still be, because these are losses that you legitimately incurred. I don't think they'll take it away from you.
Yeah, I think if we're like doom and gloomers and we're thinking of the absolute worst case scenario, maybe they're like, you can only use it to drop your income down to
that rule might be possible, where they limit how much you can actually take instead of maybe 100%, maybe to only 80%. That's happened before.
Similar to the fee simple conservation easements, you can only lower your HI for 25 or 35%.
They are cracking down on a conservation easement stuff. So I don't remember what the actual new rule is, but they are cracking down on that one.
Yeah, I don't see that ever happening with just straight passive losses.
I don't think so.
Like that.
No.
Yeah.
There'll be too much of an uproar.
And plus, it's so obscure, right? And I think I commend a lot of the investors here. It is very advanced stuff that nobody ever talks about, and it's a good thing. It's nothing really that's ever going to be on the chopping block, I think, to raise revenue for the IRS, because not a lot of people do this stuff. So why would they make the change?